expected return for the investors. In other words, what you call, in order to address any unforeseen, any unexpected loss, the minimum 10% of RAROC. That's the benchmark they fix. We have to keep high capital also. High risk business will generate more profit. The recap of what we have discussed in the previous session is RAROC calculation. How do you calculate ROROC? What is the importance, purpose of calculation of RAROC? What is its role in a investment decision taking? For the investment, for an investor, this ROROC, in what way it helps the investor to take a decision making? So that is the purpose. What is the importance of RAROC calculation is, it will tell you even after deducting or factoring the risk, cost of risk, they have come out with this much profit. In other way, it is a benchmark set by the bank to what should be the return for the investors, what should be the minimum return for the investors. In other words, it will also tell you what is the weighted average cost of capital. That also is a benchmark at the time of fixing this hurdle rate for any RAROC. What is the weighted average cost of capital? Weighted average cost of capital, they will account all the source of funds. That means the equity and debt. What is the cost of that fund to finance the total assets? So the average cost of that source of funds, equity and debt, is comprised together and will arrive at the weighted average cost of capital. That should be the minimum, what you call the risk adjusted return on capital. That should be the expected return for the investors. In other words, so that is the meaning, the purpose of calculating RAROC. It has so many implications for calculation of RAROC. The main thing is, it will give the investor a confidence level. So he will come to know that this particular financial institution has this much of RAROC, even after adjusting the risk they have come out with this much of profit. This is the percentage of profit. Net profit after adjusting the risk. That is what is RAROC tells the investor. So it can be seen that ROROC is the key factor in investment decision of an investor. So in the MCQ, it were so many examinations, this was the repeated question. So what will the following dash ABCD will help you in investment decision of an investor: RAROC, ROCE, NII, NIM, net interest margin, net interest income, return on capital, return on risk adjusted return on capital, like that. So the answer should be risk adjusted. RAROC is the key factor in investment decision of an investor. Higher the RAROC, higher would be the reward, and vice versa. This is the linkage. This is the linkage, nothing but the linkage. Linkage between what? Risk, return and capital. This is the risk, return and capital, the trinity is the linkage between the risk, return and capital. Higher the RAROC, higher would be the reward, and vice versa. The key driver in managing any business is therefore seeking enhancement in RAROC. That means higher the RAROC, higher would be the return, higher would be the reward. The position, the financial position, the stability is good. It has a sound financial background. It is worth noting that expected loss can be estimated. We can calculate the risk. Unexpected loss cannot be estimated. So enough capital is required to absorb the above two losses. That is what we always tell any investor or any borrower client. We are instructing, we are telling, we are advising the borrower client that every year they need to plow back a certain percentage of profit to the provision to the capital as reserve. So they have to keep a certain percentage as capital as buffer fund, because in order to, in order to address any unforeseen, any unexpected loss, they need to address. That is why repeatedly, a sound financial management person will keep a portion of profit, they will plow back to capital. So, enough capital is required to absorb the above two losses, expected and unexpected losses. They have to consider, provide capital, keep capital, economic capital and regulatory capital. What is economic capital? RAROC calculation. RAROC calculation, RAROC is equal to risk adjusted return on capital is equal to net profit plus return on capital if any minus expected loss will give you the risk adjusted return on investment. Risk adjusted return RAROI divided by economic capital into 100 will give you what? Risk adjusted return on capital, RAROC. RAROI divided by economic capital 100 will give you the RAROC percentage. This much will be the percentage. This is the hurdle rate which every bank used to fix for the as a return for their equity shareholders or the weighted average cost of capital like that. So those are all the tools which they use to arrive at the benchmark hurdle rate of RAROC. So this is the RAROC calculation. What is the economic capital? Economic capital is the capital a financial institution deems necessary for the risk is taking. How much risk they are taking corresponding to the volume of quantity of risk they have to keep capital to as a buffer, that's called economic capital. In other words, economic capital is a financial institution's own institutional estimate of the capital which is required for the risk it is bearing. So it is different from the regulatory capital. Then what is regulatory capital? Regulatory capital zeros in on fulfilling the objectives of regulator. Economic capital focusing on the internal management of the business to maximize the shareholders' return. A financial institution can take a certain risk when appropriate capital is allocated for that risk because the capital has a loss absorption function. The profitability of a financial institution is measured in relation to the economic capital allocated. So that is the purpose of keeping economic capital and the regulatory capital. RAROC, what is RAROC? Again, in nutshell, it describes. So it defines RAROC, it is a risk adjusted performance measure. It will tell you the performance of that particular financial institutions. RAPM, what is the full form of RAPM? Is risk adjusted performance measure has become an important tool to assess the performance of business units and strategies on risk adjusted basis, measures the performance of a business unit on risk adjusted basis. Important part of RAROC is economic capital, that is the amount of capital a financial institution keeps aside based on the risk it takes, based on the volume of risk, the percentage of risk corresponding to that percentage of risk, they have to keep capital to cushion, to absorb the losses. That's called economic capital. The ultimate objective of a risk-based capital allocation is to provide a uniform measure of performance. In absence of economic capital measurement model, regulatory capital may be used for calculating RAROC. Regulatory capital may also be used for RAROC capital, may be used for calculating RAROC. So, if in the case study, if the economic capital is not given and you are asked to find out, arrive at the RAROC, if the economic capital is not given, they simply mentioned as capital or regulatory capital. So, if it is so, then you can very well take the regulatory capital as the denominator for the purpose of calculation of RAROC. Expected loss, NP, net profit minus expected loss divided by capital. If it is economic capital, well and good, use economic capital as the denominator. Or if it is not mentioned, use this regulatory capital, or simply they will say that it is capital. So, you use that and calculate, arrive at the RAROC. A bank can have its own RAROC accepted level, that is called the hurdle rate. They say that 10% is the RAROC. That means they expect the 10% has to be paid to the investors, equity shareholders. So that should be the hurdle rate. There, what is the hurdle rate? Meaning of hurdle, it's a benchmark. They fix it's as a benchmark. It should not fall below 10%. That is the target they fix. Because even after adjusting the risk component, they have to come out with a minimum 10% of RAROC. That's the benchmark they fix. So if anything goes below this benchmark of 10%, there is a risk. That risk is not properly addressed. That risk is not properly assessed or quantified. So that is the meaning of hurdle rate. There is a benchmark. There is a stipulated minimum level. They have to achieve minimum that rate as RAROC. So they fix the hurdle rate estimated for the bank as a whole. In RAROC model, the hurdle rate may be the bank's shareholders' required return on equity. That is the return on equity. The shareholders' equity, bank at the time of issuance of shares to the public, they offer that this should be the minimum ROE, return on investments, return on equity. That equity return 10%. That is the basis of fixing the hurdle rate for RAROC hurdle rate. If they are coming, they have booked the RAROC, they reach the hurdle rate, it is well and good that they can easily part on this profit to the equity shareholders. That is the by way of return on equity. Or measure of the weighted average cost of capital. WACC, weighted average cost of capital. It is nothing but the weighted average cost of all its own source of funds. That means your own funds equity or the borrowed funds debts. So debt and equity cost is arrived at and the weighted average cost is arrived at. That is also a basis for arriving at or fixing the RAROC hurdle rate. Either they can use ROE, return on investment, as the hurdle rate for fixing up the risk-adjusted return on capital, or they can use WACC, weighted average cost of capital. So simple, you have to understand what is ROE, return on investment. It is the return the bank has to give to the investors. What is WACC? It is the weighted average cost of capital. What is capital? There is a source of funds, the total funds inflow in the business. What is the inflow of the source? The major sources are capital and debt, equity and debt. What is the average cost of that equity and debt? To fund the total assets of that bank. So they have a source of funds, that is equity and debt. They have use of funds, the total assets. So this source should finance this total assets. Okay. So this total average cost has to be arrived at. That cost, average cost, which we use as a hurdle rate to fix the RAROC percentage, minimum percentage. So ROE and WACC. Expected and unexpected losses explained again. Expected unexpected loss. Scenario 1. The bank has given a loan of rupees 100 lakhs. So what is expected loss? What is unexpected loss? It is explained in this slide. Just you read through. Bank has given a loan of rupees 100 lakhs. What is the security available? Collateral is secured by property worth 150. So 100 is the exposure. Our exposure is 100. So what is the security value? 150. So it is fully secured. Fully secured. Because exposure is 100, we have more than that of the value we have as security. It is fully covered. Over and above 50 lakhs is in excess of our exposure. We are in a safe position. What is the expected by banks? Expected loss is 0 here. So there is no expected loss here. Expected loss nil. 0. There is no expected loss. What is the capital requirement for expected loss? It is 0. Because we are fully secured. There is no worries. So here it is 0. We have collateral security. The exposure is fully covered by the collateral security. So there is no loss foreseen in this particular transaction. It is fully secured. Scenario 2, you see, Bank has given a loan of rupees 100 again here. What is the security value? Only 90. So, secured portion is 90. Secured is 90. Unsecured US. Unsecured is 10. So, 10 is the loss here. 10 is the expected loss here. 10 there is a chance of incurring losses by the bank. So at the time of recovery, if you sell out the security, you will be able to realize only 90 lakhs, but the exposure is 100. The 10 remains as the unsecured portion, which is a risk to the bank. So that bank's expected loss here is this 10. So this 10 is the expected loss. Now bank knows the volume. So here it is certain. This particular case, there is a certainty of risk because we have 90 lakh security, the unsecured portion is 10. So there is a certainty in this risk. Bank knows the volume and can keep adequate capital. So 10 is the unsecured portion, we need to keep provision of capital. For expected loss, we have collateral, NPA provisions, etc. We have provisions also. So, whenever losses are there, we are compensating. So, we are compensating with by way of capital or provisions. So, that is the certainty, uncertainty is explained in that way. You compare the value of security and the exposure, then you find out the net unsecured portion, that is the risk, that is the certainty class. Certainty is there in that, arriving that kind of risk exposure. For unexpected losses, we are not aware. We don't know how much will be the loss. What percentage is going to be defaulted. So, how do you know? Based on the historical trends, past analysis. So, if for housing loan, you find out, you arrive at, you go through and examine what was the past payback history of that particular sector, housing loan. So, how much is the percentage of default? 100 loans we have given last year, 10 loans became defaulted, NBA. They became NBA last year. So, what is the percentage of default? 10% is the percentage of default. We can calculate like that, but there is an uncertainty. How much they are going to default? We don't know. So, there is an uncertainty for an unexpected loss. We are not aware how much is the loss and how much capital is required. In such cases, losses will be directly compensated from the capital. So, if such losses, whenever it arrives, whenever it comes into reality, what we will do? So, there will be an erosion of capital because the losses are compensated by the capital. So, in that process, the capital will be eroded to make good of the losses which have already recorded. So, therefore, Basel says more capital should be kept to absorb this unexpected loss. That is what? That is why the Basel is coming out with the latest guidelines that instead of keeping the minimum regulatory capital of 9%, they have to keep more as buffer by way of capital conservation buffer, countercyclical capital conservation buffer, CCCB, like that, so many things. And also they have to add based on the issuer basis, what is the default percentage, what is the risk increase, what is the downgrade trend, all those things have to be taken care of. All the loss factor has to be accounted, like in operational risk, they say that they have to use a linear function formula which factor all the losses which are happening in the transactions in the bank, all the income are generated by the bank, all these transactions level are taken care of and they account it and arrive at the capital level. They have to keep more and more capital to absorb any unexpected loss also. Then only we can say that it has a sound prudential system of maintaining adequate capital. So, that is the need of maintaining capital to address unexpected loss also. In addition to maintaining capital to address expected loss, the bank has to keep capital to address unexpected loss as well. So, why risk management? What is the purpose? So uncertainties associated with the risk elements impact the net cash flow of any business of an investor, any investor. That is the uncertainty in the cash flow. These uncertainties leads to variation in cash flow. That is what we discussed under investment 3. There is an uncertainty. First year they generated a profit of 100. In the second year they have come out with a loss of 30. The third year they got to 210, like that. So uncertainty of cash flow is there. So any unfavorable impact leads to risk in the business, which is not constant. When cash flows are badly affected, there will be high losses. Cash flows are bad when net cash flow, inflow and outflow, wide fluctuation. If inflow is very less, outflow is more, okay, well and good. So inflow is more and outflow is less, okay, good. If outflow is more, expenses are more, then we will end up in losses. So when cash flows are badly affected, there will be high losses, which leads to capital erosion, then to total wipeout of capital. If the accounting system says that the particular unit, the particular bank is generating every year, they are booking loss every year. Where will they compensate these losses? They will take away a portion of the capital every year. So if it is repeated year after year, finally one day, one fine morning, the entire capital will be eroded. Finally, bankruptcy will be the result. So that is the purpose. That is why the banks, Basel and the regulator always keep on saying that you have to keep more and more capital to address unexpected loss as well. To save from such bankruptcy, what is required is the loss potential of the business to be controlled. That means the risk needs to be managed. That is the objective of risk management. That is the risk loss potential of the business to be controlled. That is the objective of risk management. What is the meaning? The risk needs to be managed to control the loss potential. The loss potentials are in fact the cost of the business. You know that. Cost of the business is therefore correlated to the risk in the business, which is to be managed efficiently. So, risk management in summary, risk management is the process of assessing the actual or potential dangers a particular situation, which may come. So that uncertainty, the potential danger, addressing the potential danger, the process of assessing the potential danger is called risk management. So measurement of loss potential is critical as it helps to arrive at how much capital is required. That is what repeatedly we have been telling in all the classes. How much capital is required to address, to arrive at measurement of loss potential. That's why measurement, I was saying that measurement is the most important part in risk management, because corresponding to this amount we need to keep capital as cushion. So measurement is the, whenever we fail in this measurement part, so we will end up in either providing lesser capital or more capital. Lesser capital means we will be open, we will be bound to subject to penalty by the regulator. More capital means more capital we are keeping it as idle fund, which will be not be available for lending and generating profit. The capital will be in that particular basket as an idle fund. It will not generate any profit if you are keeping more profit. So more profit is required, it is sound position of, but because over accumulation of profit is also not good. So it has to be measured. So measurement is the most important part in risk management. Measurement. So loss assessment due to risk be accounted for by treating risk as the cost of business. Need for risk management is explained. That's the purpose for keeping us profit. What is the need? So can you see you can read out this, what is the need, what is the purpose of risk management? A person brought fruits worth 50,000, one example, one case study, for selling in the market to make profit. He paid rupees 50,000 to buy fruits. One scenario which is explained, which is his capital. So this 50,000 entire thing brought in by the person as his own capital, that is the total amount of 50,000 he invested. He didn't borrow anything. He used his own savings and purchased this thing for selling and generating profit. After purchase, on the way to his selling place, the vehicle met with an accident and entire fruits got damaged or lost. Here, he incurred a loss of 50,000 and his entire capital got wiped out naturally. Here, what would have been done to arrest this loss? He should have insured the assets to reduce the losses. He can manage the risk through insurance. So, one of the risk mitigation techniques. He would have managed the risk by insuring. So, he didn't insure. This poor man utilized the entire capital for purchase of these fruits, and on the way met with an accident. This entire capital he lost. Erosion of capital. If at all he receives a part amount, say 45,000, his loss will come down to 5,000. In that way, loss can be managed. So, that is the mitigation process is explained here in this particular example. Because he didn't insure that person, the entire capital has been wiped out because he didn't act efficiently to overcome the uncertainty. That is what is explained in this case study. So, why risk management? It may be noted that risk needs to be managed to control the loss potential and from bankruptcy. This loss potential or the cost of the business, which is correlated to the risk in the business, which has to be managed efficiently. So, what we discussed only in bullet points, it is again repeated here as a recap. Controlling the level of risk to an organization's capacity to bear the risk is the essence of risk management. Controlling the level of risk. That is what is intended to in this risk management. So, risk management requires not only identification of risk, but also their measurement, control, mitigation, and estimating the cost of risk. So, we have understood what is risk. So, now we know, as a recap, we know what is risk. Risk is the uncertainty which will affect, impact badly the profit. Financial risk, it will affect our profit, or outright losses, it will end up financial risk. Risk elements, the uncertainties of cash flow. High risk business. So, when the risk is more, we have to keep high capital also. High risk business will generate more profit. Risk free business, zero risk business, what we explained is about the bank FD. So, there is zero risk. Risk is free, risk free business. What is the linkage among risk, capital and return? Capital and return. What is the capital requirement? The regulatory capital and economic capital we discussed. Then expected losses, EL. EL calculation or cost of risk. Expected loss is also called cost of risk. Risk adjusted return on capital. So, this bullets point you have to note down and you have to recap. This is actually a revision slide. What we have discussed only, we have entered, shown as this slide in this slide. Just you note down, and whatever we discussed only, it is covered in this slide. Risk adjusted return on capital. Why risk need to be managed? Loss potential or cost of risk, etc. So, risk management is basically to control the risk. More risk means more capital. Through risk management, we arrest loss potential. Measuring the loss potential or measuring the risk is very important in risk management. Measuring the risk. So, first step what we discussed is risk identification. Once you identify the risk, you have to measure. That measuring the potential or measuring the risk is very important, very, very important in risk management. Risk management is therefore assessing the risk, measuring the risk position or loss position, and then providing for that loss by way of increased capital. That is what we discuss in RAROC. If you have a higher percentage of RAROC, it will tell that the risk already adjusted, then also they have come out with sufficient percentage of profit. Let us familiarize with the terms probability and impact. What is the probability? So, we have been discussing about the uncertainty. So, uncertainty is a probability. What is the example for that uncertainty? probability in credit, that is default. So default is a probability. If they commit default, if a customer commits default, what will be the impact on that particular business? So what is the relationship between probability and impact? Let us understand what is probability, what is impact. Probability is a situation where loss may happen. Suppose if one borrower commits default, there will be a loss which may happen if he commits default, or may not happen. Sometimes it may not happen also, but even then we have to account for that uncertainty, that probability. So yes or no, we don't know whether it will happen or not. At the time of lending out this money, you are not aware that this fellow will commit this percentage of default or not, we don't know. But still, based on the past history, we will arrive at what is the percentage of default, that what is the probability of default. Here bank has to assess how much loss is going to happen, that is the probability. So impact is the situation where the bank sees what will be the impact, how much loss happened and how much will be the risk. What is the percentage of risk? What is the percentage of, what is the impact of that probability? That probability score is 10%. Suppose the probability percentage is 10. That means there is a 10% chance that the percentage, this person may commit default. If its impact we arrived at is 5, probability into impact will give you the risk score. That is the total probability, the chance of making a default, probability and impact. So what is the probability? What will be its impact on your business? So probability into impact will give you the risk score. So this percentage, this particular borrower will commit 10% default and it will have an impact of 5%. So 10 into 5, so 50 will be the risk score of that particular unit.